Unit 1, Topic 3, Video 1. Hello students. In previous topic we discussed about accounting terminologies. Now we will continue with accounting concepts. Let's start with its meaning. Concept denotes logical consideration and a notion which is generally and widely accepted. These are rules of general application which helps in selection of an appropriate method in particular circumstances. Now, we will discuss different accounting concepts, that is, business entity, going concern, accounting period, money measurement, stable monetary unit, historical cost, dual aspect, realization, matching concept, and at last, accrual concept. Let's discuss these concepts briefly. First is business entity. According to this concept, the business and its owner are two separate legal entities. Any private and personal incomes and expenses of the owner should not be treated as the incomes and expenses of the business. For example, Mr. A starts a new business, Messrs. Independent Trading Company, and introduced a capital of $2 lakh in cash. It means the cash balance of Messrs. Independent Trading Company will increase by a sum of $2 lakh. At the same time, the liability of Messrs. Independent Trading Company in the form of capital will also increase. It means Messrs. Independent Trading Company is liable to pay $2 lakh to Mr. A. Next concept is going concern. According to this concept, accounting assumes that the business will continue to exist and carry on its operation for an indefinite period in future. We record all the financial transactions of a business in keeping this point of view in our mind that a business unit is a going concern, not a gone concern. Otherwise, the banker will not provide loans, the supplier will not supply goods or services, the employees will not work properly, and the method of recording the transaction will change altogether. For example, a business unit makes investments in the form of fixed assets, and we book only depreciation of the assets in our profit and loss account, not the difference of acquisition cost of assets less net realizable value of the assets. The reason is simple. We assume that we will use these assets and earn profit in the future while using them. Next, we have accounting period. The life of a business unit is indefinite as per the going concern concept. To determine the profit or loss of a firm and to ascertain its financial position, profit and loss accounts and balance sheets are prepared at regular intervals of time, usually at the end of each year. This 1 year cycle is known as the accounting period. Normally, an accounting period is for 1 year, which can be a financial year, that is, 1st April to 31st March, and calendar year, that is, 1st January to 31st December. The purpose of having an accounting period is to take corrective measures, keeping in view the best performances, to nullify the effect of seasonal changes, to pay taxes, etc. Based on this concept, revenue expenditure and capital expenditure are segregated. Revenues expenditure are debited to the profit and loss account to ascertain correct profit or loss during a particular accounting period. Capital expenditure comes in the category of those expenses the benefit of which will be utilized in the next coming accounting periods as well. Accounting period helps us ascertain correct position of the firm at regular intervals of time, that is, at the end of each accounting period. Moving further, next one is money measurement concept. This concept assumes that only those business transactions need to be recorded in the books which can be expressed in terms of money. Money is a common denominator to measure assets, liabilities, income, and expenditure. For example, item that cannot be recorded as accounting transaction because it cannot be expressed in terms of money is employee skill level. Next accounting concept is stable monetary unit. This concept assumes that the purchasing power of the money remains the same throughout. It ignores the changes in the purchasing power of the money due to inflation or deflation. Next one is historical cost concept. According to this concept, assets should always be recorded in the balance sheet at the cost of acquisition. This concept ignores the market value or current value of the assets. For example, goodwill is not recorded if nothing is being paid for it. Next concept is dual aspect concept. For every debit, there is a credit. Every transaction should have a two-sided effect to the extent of same amount. It states that every transaction affects two accounts in their respective opposite sides. This concept results into the accounting equation. For example, if we buy some stock, then it will have two effects. The value of stock will increase, and it will increase our liability in the form of creditors. Next concept is realization concept. This concept states that revenue should be included in the books of accounts only when it is realized. The term realization means creation of legal right to receive money. According to this concept, sale should be recorded in the books when right to receive cash on the sale of goods or services has been created. And the second last concept is matching concept. Matching concept is based on the accounting period concept. The expenditures of a firm for a particular accounting period are to be matched with the revenue of the same accounting period to ascertain accurate profit or loss of the firm for the same period. This practice of matching is widely accepted all over the world. And the last concept is accrual concept. As stated earlier in the matching concept, revenue and the expenditure related to the accounting period is considered. Accrual concept says if we sell some items or render a service, then that becomes our point of revenue generation, irrespective of whether we have received cash or not. The same concept is applicable in case of expenses. All the expenses paid in cash or payable are considered and the advance payment of expenses, if any, is deducted. Most of the professionals use cash basis of accounting. It means the cash received in a particular accounting period and the expenses paid in cash in the same accounting period is the basis of their accounting. For them, the income of their firm depends upon the collection of revenue in cash. Similar practice is followed for expenditures. It is convenient for them, and on the same basis, they pay their taxes. I hope you all are clear with accounting concepts which we have discussed. Thank you.